This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, a disaster strikes a major company, which is sending shockwaves across its entire industry. And as you're about to see, is threatening to spread across the entire U.S. economy. And in fact, it's already started. Now let's over to Bloomberg, where we picked today's story up with a headline: U.S. new home sales unexpectedly slump to a one-year low. And this shouldn't be something that we hear the term unexpectedly used, because what this suggests is that perhaps the mythical soft landing isn't indeed happening. And perhaps there are other forces now impacting the U.S. economy, as you're about to see with this major company that's having broad effects across multiple industries. And here we can see the decline in sales may represent a temporary setback for the housing market that is otherwise on the mend. And in fact, it's so bad that contract signings declined a whopping 12.2% in November. And reports earlier in the week showed a 6-month high in housing starts and a pickup in home builder sentiment. And we warned about this in the past, that what would happen is home builders would get excited. They would see interest rates perhaps starting to come down. They see a housing shortage and they would start building like crazy. Now, some of you may remember the 1980s when builders were doing the same thing and they got completely crushed, as they do, usually going into every downturn. But what's changing now is something on the side of the buyers, which suggests that indeed something is spreading through the economy, and quickly. Especially when weighed against the high new home starts number released early this week, low new home sales in November aren't particularly significant. Of course, if that's what happens when you see the number go the wrong way, if it was up, it would be highly significant, because the new home market is shaping up to have a good 2024 with already high inventories and more in the pipeline. When rates come down next year, there's going to be a surge in sales. Well, I love it when people say things like that, because as you know on the show, we like to challenge the broad narrative here. And what did we just see there? There's a huge amount of inventory. There's a huge amount of building. And yet the hope is rates will come down and buyers will come flooding in, and there will be a fantastic 2024. But perhaps we're setting up for just the opposite to happen. Here we can see the yield on 30-year treasuries. This correlates into, of course, mortgage rates, that shown in blue, against new one-family houses sold, this in the United States, that in red. And we can go back and look at the 1980s, and what do we see? There is a case that indeed you see rates go up, well, housing sold go down, and then you see rates coming down, and then you see the opposite, sales go up. But how about what happens if we fast forward a bit? We notice after the 1980s, something changes in the U.S. economy. It also affects because we go into a global economy, and now what happens? You see 30-year rates falling, going into the recession in the early 90s. What happens? You see houses sold come crumbling down. It's kind of different than what we saw in the early 80s. Fast forward now, of course, into the dot-com bubble. We notice the same thing. Rates going down, housing starts or housing sold going down. We see that happen again in the global financial crisis. Again, lower rates are not leading to more demand here. It's telling us something else is going on in the economy, which is evident now as the experts suggest that falling rates are going to be a boom to the housing market. But in fact, as you're about to see, there's not going to happen. In fact, the opposite is likely. Builders are going to be sitting on too much inventory. They're going to be forced to slash prices. This is going to backflow, of course, into the existing home sales market and push prices down, and that will put even more pressure on all the banks holding these mortgages. And here we can look at the net percentage of domestic banks tightening lending standards, well, for everything. That's shown in many different colors. Against in red, new one-family houses sold here in the U.S. And what do we note? That as banks tighten lending standards, we can go back to the dot-com bubble, and what do we see is that new homes sold start to slow down. And this would make sense, because when you see periods where credit is being tightened, well, people go to get a loan, and the answer sometimes comes out to be, well, no, you don't qualify. If you don't qualify, that means fewer homes are sold. That's what the builders don't see here. They're seeing this from a one-dimensional aspect. The lower rates mean that people will buy because the payment will go down. In a sense, people will be excited about it until they go and try to get the mortgage and find out that they just don't qualify. And then we move forward into the global financial crisis. Again, we see banks tightening lending standards. We know that rates were falling there, but it didn't matter because even lower rates couldn't get the banks to lend. Simple reason, lower rates mean financial conditions are tightening. Now you hear just the opposite from the central elites who say that lower interest rates mean things are easy. No, it means things are tightening, getting worse for the banks. And when things get worse for the banks, people don't get loans and, well, they can't buy homes. We see that. Now, what we don't see here is during the pandemic, banks did tighten lending standards, but what happened? New home sales went up. Why? Because people had money. They were given money by the government. Now we see the same effect. New home sales heading down. This shouldn't be a surprise. Banks are indeed tightening lending standards. So now let's move forward because what we see here is some effects that's now we look at the broad economy. We know disaster is coming for this major company. We know it's likely spreading. We're seeing it in the housing market. But one area that we didn't see it today was in durable goods. As U.S. durable goods orders surged the most since July 2020, this from Zero Hedge, but they say, hang on, the last few months have been volatile, which is pretty normal for U.S. durable goods orders. November saw orders surge 5.4%, the biggest jump since July 2020, and this sent the year-over-year orders growth up 10.1%. But hang tight because the headline orders print was more than double the 2.3% month-over-month expectation, and ex-transports, durable goods jumped a whopping 0.5%. A surge in orders, primarily based on non-defense aircraft parts and orders, surging an incredible 80.1% month over month. And as goes Boeing, well, they're asking, does that mean the S&P 500 goes up? Well, we know the market continues to try to press higher. The S&P looking to make all-time highs, the NASDAQ already there. But what is the likely path for the economy? Because what we're seeing with this major corporation, is it really going to have a knock-on effect outside of perhaps housing? Well, the answer is yes. Here you can see manufacturers' new orders, this in terms of durable goods. And the reason we need to talk about this is because major companies, well, they produce goods. Of course, that shows up in the economic data. Now, let's take a look at continued claims. This is something we'll save a little bit later as we get into this later part of the show, is we look at the number of people that are on unemployment and cannot get back into the workforce, that's shown in red. And what happens as more and more Americans end up on unemployment, can't find work, what happened? Demand goes down, orders fall, and it makes sense because when you're on unemployment, particularly when you're on it a long time, your income goes down, your discretionary spending ability drops, and particularly in a high interest rate period, your debt service cost is going up. Not to mention, if you did a bunch of those buy now, pay laters, it's going to come back and bite you. And here we can move forward to the global financial crisis. We see the same effect as more and more Americans go on unemployment and stay there. Demand for goods falls. You see that even going into the pandemic, as the economy was slowing down, what happened? People were getting stuck on unemployment. Even though it was fairly low levels historically, it still brought new orders down. Now we're seeing, of course, people on unemployment, the highest level now in many, many months. In fact, in what we know, going back almost 2 years, we see this surge higher in new orders. But my friends, it's going to roll over. And as we look at the Fed's preferred gauge of inflation, we talk about demand, and this is all again feeding into the story of why this company is facing problems, why other companies in this industry are going to face problems, why the U.S. economy is indeed facing issues. Because when we talk about inflation, it's all about supply, but the big one, demand. As the Fed's preferred inflation gauge cools, reinforcing rate cut tilt, and that rate cut tilt is causing, of course, stocks to head higher, as many people say, wait a minute, the economy's slowing down, stocks should be falling, but yet they're surging higher on this Goldilocks scenario. But yes, you could have taken advantage of that. I'm going to show you how easy, because we have some big updates coming in January for our reports. Many of you said, Steve, can you make these easier? Can you just point out the ones we should be buying? Well, the answer is it's coming. Talked to the programmer the other day. He said he hopes to have it done by January. We'll keep the reports the same, but we're going to give you a little bit more. And now you can still get in before the change. As October, you look back to October 9th, we saw our machine positioning come off these deep short positions for the NASDAQ. This is a QQQ, the largest NASDAQ 100 ETF. And we paired that with our Momentum Timer Pro report, because what our CTA report does, it looks at the machine's positioning. But what we do is we go back through history, we run a historical overlay. So when we see extremes, particularly to the downside, that tells you when you ought to be buying is when it flips to the upside. You pair that with our Momentum Timer Pro report, and that looks at the technicals. What did we notice on October 9th? What happened there? The technicals, momentum indicators, all switched positive. There's that one daily buy count, and what happened if you would have bought at market open on that green candlestick? Right now, you'd be up 12.9%. Those reports are that easy, and one trade could pay for years of your research with us. Links in the description below. Right now, 3 coupon codes for a free month for each one. Get them before they're gone. If you get to checkout and they're gone, somebody beat you to it, but we want you to try the reports. We want you to make money because we know you'll stay. But one thing that is going away is demand for the U.S. economy as so-called core personal consumption expenditures, which strips out volatile food and energy components, increased 0.1% month earlier after a downward revised 0.1% gain in October. Now keep this in mind. We keep hearing from the Fed as they move the goalposts around that the core CPI, the core PCE, these are the new goalposts that we have to achieve. And we've talked about on the show how these move down rather slowly, but we're starting to see that we're getting right near the Fed's target. And that means the market's starting to price in cuts. What we're trying to suggest is we're about to shoot through the Fed's target in a big way. And here we can see from a year ago, the Fed's preferred gauge of underlying inflation advanced 3.2%. Again, a slowing trend. But here's the big deal. On a 6-month annualized basis, the core metric rose 1.9%. So I want you to be thinking, now if we just zoom into the last 6 months, we're on target. So as we go forward over the next 6 months and we put up these low month-over-month prints, what does that tell you the year-over-year comp's going to be in 6 months from now? Well, it's going to be below the Fed's target. Maybe even worse if we're in a recession. The first time in more than 3 years this has happened that the measure is below the Fed's target. And while inflation data is good news for the Fed, robust income figures in Friday's report may help fuel consumer spending and lead central bankers to wait before easing policy. But is it really about incomes here? Because if that was the case, this major company wouldn't be seeing problems. I'm going to tell you what's really going on here in a bit. As personal spending adjusted for changes in prices rose 0.3% after a downward revised 0.1% advance in October. Real disposable, this is inflation adjusted when you see the term real, disposable income, the main support to consumer spending, climbed the most since March, suggesting that consumers are indeed getting a bit here ahead of inflation. It's a good sign. The problem we have, it's just too little and way too late. As sustained easing of price pressures and resilient household demand are consistent with views of a soft landing for the economy. Inflation that's in line with the Fed's 2% goal also explains why Chair Jerome Powell and other policymakers have set the table for interest rate cuts in coming quarters. So what the problem here is, if demand was so strong, wait till you see the next story. As we look at personal consumption expenditures in the chain price index, that on a year-over-year rate of change in blue against total compensation, this is average hourly earnings multiplied by average weekly hours of production of non-supervisor employees. This shown in red, we do see now for the first time that wage growth in terms of total compensation is now consistently higher than Fed's preferred gauge for inflation. The problem is it's almost meaningless. In fact, where the PCE goes, as you can see here in the past, not all of the indications highlighted, well, that means total compensation is indeed headed lower. And this is a problem because it's back feeding now into Nike. And this is why we're a Foot Locker. We're not here just shopping for shoes, although we probably could use some new sneakers. The issue is what's happening in Nike means it's going to be problems for Foot Locker, and that means problems for the entire retail industry. And that's why I wanted to take you through the setup here of what's going on around the rest of the economy, because it's not just isolated to what's going on with Nike. And they see their shares plunge after sneaker maker cuts their revenue outlook. And Nike said in its earnings report on Thursday that the company now expects its revenue to grow 1% for the fiscal year, down from the prior outlook of mid-single-digit growth. The company was also going to cut costs of upwards of $2 billion over the next 3 years. And when you hear cost cutting, well, it doesn't mean they're going to trim your shoes. It means they're trimming heads, at least that at their offices. The new outlook reflects increased headwinds, quote, particularly Greater China. An EMEA finance chief said, and that he noted digital traffic softness, that's a key thing, less online shopping, and a stronger U.S. dollar that has negatively impacted second half reported revenue versus 90 days ago, notably a big change now. You know, we look back at the last quarter, GDP numbers were up, demand was up, and we said, watch out when all this pandemic stimulus is gone and all of a sudden it sets in that people have to pay on their student loans, which we know a lot of people aren't paying. We see that even small businesses can't make their rent. We see credit card minimum payments going up. We see all this stress, and it's backflowing into, of course, major companies like Nike, which filter down to retailers like Foot Locker. And guess what you don't need? If you don't have as many sales, you don't need as many employees. But they also acknowledge the company's report, quote, provided ample fodder for bears with slowing growth momentum as a result of tougher macro, pointing to a more promotional competitive marketplace. That translates simply into price cutting and disinflation, and the company is now speaking more comprehensively to key franchise lifecycle management, which will weigh on sales momentum going forward. Well, don't worry, Nike, momentum is about to get worse, as you're going to see. When we look at personal consumption expenditures coming back here to the chain price type index against advanced retail sales as shown in red, what we can note is where the PCE goes. Well, it's following retail sales lower. We get this indication here that as the personal consumption expenditures, or we see as demand continues to fall, well, eventually that means it drags retail sales down with it. That is an indication of exactly what we would expect to see in terms of job cuts, and that's why we're looking at this now as U.S. initial jobless claims tick up and remain near, but yet remain near historic lows, because this time we see first-time filings rose a mere 205,000. And I know what you're thinking, Steve, these are really historical low numbers. That means there should be no problem here in the U.S. labor market. But wait, there is. Recurring applications have been trending higher in recent months. In fact, we're at a 2-year high, indicating Americans laid off by their employers were having a harder time finding new positions. The latest figures indicate continuing claims over the past 3 weeks. Well, they've stabilized. What we need them to do is come down, because where continued claims go, initial claims eventually follow. The question here we're going to be looking at in a matter of weeks is how much of this on the initial side was due to the holidays, and will that change as we get into January and later into February? And the answer, I believe, is yes. And here we look at continued claims in blue against total compensation in red. As a reminder, that is the average weekly hours multiplied by average weekly hours, or average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in red, and again, on a year-over-year rate change. And what we can see as more people are on unemployment, well, total compensation goes down. And right now, we see the Goldilocks scenario for the Fed occurring as they look to say inflation's coming down, but total compensation is looking good. The reality is you come back here to the dot-com bubble, and as continued claims went up, compensation went down. Same with the global financial crisis, same going into the pandemic, and guess what? It's eventually going to happen here. I think as we get into January and February, there's going to be a big issue, because what's been driving the U.S. economy? Well, a whole lot of debt. As revenge spending drives U.S. credit card debt past a whopping $1 trillion, as Americans have spent down their savings, that's not a good sign, and racked up debt as the economy hums along, but experts are pondering whether consumers can keep going. The Fed says yes. As you know, I say, well, no. Credit card balances in the U.S. increased by a whopping $48 billion in the third quarter alone, pushing the total over the trillion mark to $1.08 trillion. This according to the New York Federal Reserve. And that was before the holiday shopping season started in earnest. The bills are mounting at a time when average annual percentage rate has soared north of 20%. To the highest on record. That's going to put a lot of stress on households. And at the same time, an estimated 40% of Americans have drained their pandemic savings to afford ballooning bills. And videos on TikTok are detailing the so-called, quote, silent recession, as millions struggle to keep up with their student loan bills, card payments, higher housing costs, and elevated grocery bills. This has experts worried that many consumers are increasingly relying on credit cards and other debt, such as that buy now, pay later. We know that is a disaster in the making, because what's going to happen is all this debt load is going to get carried into the first quarter. What's likely going to happen is you're going to see people losing their jobs because, of course, people were hired during the holiday season to deal with the additional demand. As demand goes down in January, which historically it does for retailers, you're going to see them cutting hours, trimming people, they'll go on unemployment, and next thing you know, there won't be any jobs for them. And as consumers are gripped with these high cost of debt service and all these new debt bills, well, their demand for spending will go down in the first quarter or maybe longer of next year. You get a backfeed into the economy. And what happens? Well, is a recession. As consumers have leaned on their available credit lines for necessities, that's not a good sign. And things we expect consumers to be able to pay with for cash they have on hand, suggesting that they don't. And that's a problem because consumers are running out of room. As delinquency rates for credit cards are just slightly above pre-pandemic levels. But economists warn the outlook on consumer debt is starting to darken, a case that we've been making. It's only a matter of time before these rising delinquencies actually show up in the data. Some banks are reducing credit limits and closing unused line of credits. Shocking. They already know what's coming. An indication that consumer debt won't play the locomotive role it did in driving spending in 2024. No, it means the banks realize trouble is brewing. It's not only credit cards where consumers are building up debt, they're student loans, auto loans. And if you look at how much interest costs are eating away the paychecks, it's as big as it's been since 2008. And of course, we know what followed that. And that's one reason everyone's worried. But you can note the delinquency rate is indeed headed higher. As we look at total compensation against delinquency rate, this for all loans at all commercial banks in blue. And we can see that as total compensation goes down in red, delinquency rates on loans go up. We see that here in the 90s recession, going into the dot-com bubble, going into the global financial crisis. And guess what? My friends, we're seeing it now. That's why companies like Nike and like Foot Locker and the housing market and durable goods news orders and all these other issues are going to be a big problem. They're all going to see a slowdown. It's coming back to the fact that consumers are tapped out. They have way too much debt, and the U.S. economy has no option now. There's no way to save it. It's just only a matter of time before everything comes tipping off the edge. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.